Welcome to TalkTickers. You're busy, but staying informed about company performance is crucial. That's where we come in. Today, we're diving into the first quarter 2025 earnings call for O&S Semi, extracting the key insights so you can quickly grasp what's important.
Yeah, so R&S Semi reported Q1 revenue of $1.45 billion, and non-GAAP earnings per share came in at 55 cents. Both of those figures actually landed above the midpoint of their own guidance.
Okay, better than expected then. And the margin?
Non-GAAP gross margin stood at 40%. But what really caught my eye was the free cash flow. Big jump there.
Yes, that free cash flow number really stood out. I saw that, a 72% year-over-year increase.
Huge. It reached $455 million, which is 31% of their revenue for the quarter.
Wow. And it sounds like they're putting that cash to work, returning it to shareholders.
Exactly. They repurchased $300 million in shares just in Q1. That's 66% of that free cash flow. And the plan for the full year 2025 is to ramp that up to 100% of free cash flow via buybacks.
100%. Okay, that's a strong signal. All right, let's dig a little deeper then. How did they actually generate that $1.45 billion in revenue? What did the different segments look like, especially with the current economic backdrop?
Well, the total revenue, like we said, $1.45 billion. It did beat their guidance midpoint, so that's positive given the macro challenges.
Yeah.
But yeah, performance was definitely mixed across the board. Automotive, for instance, saw a pretty significant sequential decline, down 26%.
26%, after a strong Q4, right?
Exactly. But it was largely expected. They pointed to weakness in Europe and then the usual seasonality in Asia, particularly China, with the Chinese New Year timing.
Right. The auto market's definitely been choppy. How did the industrial side compare? Did that hold up better?
It did, actually. Industrial performed better than they anticipated. It was only down 4% sequentially.
Yeah.
And within that, traditional industrial is showing some, let's say, early signs of stabilizing. Plus, the medical and aerospace and defense parts actually grew quarter over quarter.
Okay, so some bright spots there. And what about AI? We keep hearing about AI data centers. Did that contribute much?
Oh, absolutely. Their AI data center revenue, which they report under other, more than doubled compared to last year.
Doubled year over year. Okay.
Yeah, so they're clearly tapping into that massive AI infrastructure build out.
Got it. So let's break down the main groups then. Power Solutions Group, PSG, Analog and Mixed Signal, AMG, and Intelligence Sensing, ISG. How did they stack up?
Okay. PSG revenue was $645 million. That was down 20% quarter on quarter and down 26% year on year.
Oof.
AMG brought in $566 million, down 7% sequentially and 19% year over year.
All right. And ISG?
ISG was $234 million, down 23% quarter on quarter and 20% year over year.
So declines pretty much across the major groups, but offset somewhat by that AI growth you mentioned in other.
Exactly. Those established segments faced headwinds, but AI was a clear growth driver.
Okay, let's pivot to profitability. That 40% non-GAAP gross margin. It sounds okay, but you mentioned it was down. What drove that?
Right, 40% was lower both sequentially and year over year. The main culprit was simply lower revenue volume. When you produce less, those fixed manufacturing costs get spread over fewer units. It's called under absorption. That hits your margin.
Understood. So factory utilization, how are they running the fabs?
Utilization actually ticked up slightly, went from 59% in Q4 up to 60% in Q1.
Just a small bump then?
Yeah, but they're actively working on efficiency through their Fab-Right initiative. That's their big push to optimize manufacturing. As part of that, they cut internal fab capacity by 12%.
12% capacity cut. What does that mean for costs?
They expected to reduce annualized depreciation by about $22 million. We should start seeing that benefit hit the income statement in Q4 this year.
So longer term savings kicking in later. Were there other cost actions? It sounds like they're trimming things.
Oh, yes. They launched a company-wide restructuring, too. That involved about a 9% cut in the global workforce.
9%. Significant.
Yeah, and reducing non-manufacturing sites as well. They expect this to save about $25 million in Q2 compared to Q1.
$25 million just next quarter.
Right. And then another $5 million per quarter savings in the back half of the year.
Okay, so a very clear focus on streamlining. Did they update how utilization changes affect margins now with these changes?
They did. They now estimate that for every 1 point increase in utilization, gross margin should improve by 25 to 30 basis points. That's up from their previous estimate of 25 basis points. So the capacity cuts are making utilization gains more impactful on the bottom line.
Got it. Okay, looking forward then. What did they guide for Q2 2025? What should we be watching?
For Q2, they're projecting revenue between $1.4 billion and $1.5 billion. So potentially flat to slightly down sequentially at the midpoint.
Okay. And margins.
Non-GAAP gross margin is guided between 36.5% and 38.5%. That does include about $8 million in stock-based comp, and importantly, 900 basis points of those non-cash under absorption charges. They expect utilization to dip slightly again in Q2.
900 basis points from under absorption. That's a big chunk.
It is. They said about half of the sequential margin decline is from that increased under absorption. The rest is mostly unfavorable pricing.
Pricing pressure. How much?
They mentioned low single-digit declines, so some pressure there.
Okay. What about operating expenses and the bottom line, EPS?
Non-GAAP OPEX is expected between $285 million and $300 million. That includes $29 million in stock comp. Other income should be a net benefit, around $11 million. Tax rate non-GAAP, around 16%.
In the share count, with the buybacks.
Expected around 419 million shares on a diluted non-GAAP basis. All that leads to a non-GAAP EPS range of 48 cents to 58 cents.
48 to 58 cents. Okay.
Yeah.
And CapEx for Q2?
Pretty light, between $70 million and $90 million.
Right. It definitely sounds like they're navigating a tricky period, but taking clear actions on costs and efficiency. Beyond the Q2 numbers, what were the bigger strategic themes?
Well, the main strategy remains consistent. Streamline operations with Fab-Right, keep investing in R&D for differentiated products. The goal is clear margin expansion when the market recovers. They also really highlighted their diversified global supply chain as a key advantage, especially, with current geopolitical tensions. They feel it minimizes direct impact from tariffs.
That makes sense. And despite that automotive revenue dip you mentioned earlier, it sounds like they're still making inroads in EVs.
Absolutely. That was a key point. Leading OEMs are adopting their silicon carbide for next-gen EV platforms. They specifically mentioned a new 750-volt PHEV design win with a major U.S. automaker.
PHEV, okay, and China. That's a huge EV market.
Yeah, they expect their silicon carbide to be in nearly 50% of new EV models launching in China in late 2025. That includes plug-in hybrids too.
50% share in new China models. That's ambitious.
It's a strong target, shows their confidence in their tech there.
And progress in the AI data center space. You said revenue doubled year over year. What else?
Yeah, they're leveraging intelligent power, silicon carbide, the whole portfolio. They're shipping to the top 3 UPS uninterruptible power supply vendors. And they expect revenue growth just from those UPS solutions to be 40 to 50% for the full year 2025.
40 to 50% growth in UPS alone.
Wow. Plus, they're ramping up PSU and BBU solutions with a large U.S. hyperscaler. So multiple angles into the data center.
Okay. And what about their TRIO platform? Is that starting to contribute?
It is. Revenue's being recognized now. They expect the number of products on that platform to double year over year. The long-term goal there is $1 billion in revenue by 2030, targeting really high gross margins, like 60, 70%.
$1 billion by 2030.
Okay.
Long-term play. You mentioned some pricing pressure earlier. How are they thinking about pricing strategically?
They framed it as using pricing as a tool, sort of opportunistically, to defend or gain share in strategic areas during this downturn. So yes, expect low single-digit declines in some parts, but it's not like across the board or tied to specific geographies. It's tactical.
Tactical pricing, okay. And they're also shedding some non-core businesses?
Correct. They exited about $50 million worth in Q1. The target for the full year is around $300 million, but they noted that depends on market conditions and, getting decent margins on those divestitures.
Makes sense. Okay, last piece before we get to trade ideas. Inventory, always a key metric. How are they managing that?
Right. Inventory on hand was 219 days. Now that's down in dollar terms, but up in days because revenue slowed.
219 days seems high.
It does, but it includes what they call strategic bridge inventory, mainly for the silicon carbide transitions. They expect that bridge inventory to peak in Q2. If you strip that out, their base inventory is actually around 119 days, which is right near their target of 120 days.
Okay, that context helps. What about inventory in the channel with distributors?
Distribution inventory also dipped slightly in dollars, but the weeks on hand increased to 10.1 weeks. So a bit elevated there too.
Got it. And looking ahead to Q2 segment growth.
They expect industrial and the other category, remember, that includes AI to grow mid to high single digits sequentially.
Okay, some growth there.
But auto is expected to be down high single digits again in Q2.
More auto weakness expected. And the long view on silicon carbide, still bullish despite competition.
Very bullish. They expect to maintain and gain share. They pointed to performance advantages and their tech roadmap, including a new trench architecture hitting revenue in 2026. Interestingly, they said in China, their main 6B competition is still other global players, not really local Chinese vendors yet, because of the high performance needs.
Okay. Any other forward-looking nuggets? OpEx?
CapEx.
Yeah, they expect OpEx to drop another $5 million per quarter in Q3 and Q4, beyond the Q2 guidance. And full year 2025 CapEx should be pretty low, mid-single-digit percentage of revenue, mostly just maintenance.
Low CapEx, good for free cash flow. And China tariffs? Any worries there?
They seem pretty comfortable. Having manufacturing in China plus founder relationships gives them flexibility to manage potential reciprocal tariffs, was the message.
All right, quite a bit to unpack there. Let's shift gears to our This Is Not Financial Advice segment. Time for some outrageous but plausible trade ideas based on all this. What's one thought?
Okay, here's one. You look at ONS Semi's strong position in silicon carbide, especially targeting that huge China EV market, nearly 50% of new models, they hope.
Yep.
And their edge seems to be in high performance, where local Chinese competitors aren't quite there yet.
Right.
So an idea, again, totally speculative, could be go long a China-focused EV ETF, betting on that market's growth where ONS is strong, but maybe hedge it by shorting a broad semiconductor ETF, just in case the whole industry faces more headwinds.
Yeah.
You're trying to isolate ONS's specific China EV strength.
Interesting. Leveraging their specific strength while hedging the sector. Okay, plausible, definitely outrageous, not advice. Here's another angle I was thinking about. Look at how aggressively ONS is cutting costs, the Fab-Right stuff, the workforce reduction, and then pairing that with the commitment to return 100% of free cash flow via buybacks this year. That's a huge focus on shareholder returns, even now.
Yeah, very clear signals.
So maybe a pairs trade idea. Go long ONS Semi, betting on that efficiency drive and capital return focus being rewarded. And short a competitor, maybe a similar size semi company that isn't being quite so aggressive on cost cuts or buybacks right now. The thesis is ONS outperforms its less disciplined peers. Again, just an idea for you to think about, absolutely not financial advice.
Right. So that was our deep dive into ONS Semi's first quarter 2025 earnings call. We've hit the financials, the strategy, the outlook, and tossed out a couple of unconventional trade thoughts based on it all. Hopefully that gives you a really efficient understanding of what went down. You know, what stands out to you from this? What other questions does it raise? We always encourage you to do your own homework and reach your own conclusions. Thanks for tuning in to TalkTickers.